Good morning, and this is another video on the 15th of September 2023 for the International Arbitrage podcast. And today we're going to talk about, or begin to talk about development in the United States. This is the SEC has put down some new rules, a lot of new rules for private fund advisors. And this is going to have significant implications for those persons doing international businesses who are raising money from U.S. investors in the United States. It's going to have implications for U.S. investors in U.S. businesses and U.S. owners as well. But in particular, this is going to have major implications for family-owned, small, medium-sized, family-owned, owner-managed businesses that are non-U.S., owned by non-U.S. persons based outside of the U.S. and raising money from U.S. from U.S. investors. In previous videos, we have outlined the challenges that, or we're in the process of outlining the challenges that international business owners, families face when it comes to raising money in the U.S. and you're a non-U.S. owner and you're a non-U.S. business. And raising money from U.S. investors faces a number of challenges. And we're also talking about businesses that are less than $100 million on the balance sheet or raising less than $100 million. So if you're raising $30, $40, $50 million, then these issues impact you. We're not talking about U.S. domestic funds and U.S. domestic companies, and we're not talking about large multinational large U.S. companies that are doing international business, raising money internationally, or large companies in other countries, going into the U.S. and doing things, either getting investment or doing business. Large companies, large multinational companies and brands do not have the problems that small family-owned businesses have. And small, as I said, is key to understand that small is defined as less than $100 million, because if you're doing less than $100 million, regulated institutions in your country, in the U.S. and elsewhere, treat you very differently, or the options available for you are much different than, say, these larger companies which are more than doing more than $100 million. So let's get into it. So the U.S. SEC has dropped what are new private fund advisor rules. We are going to talk about these private fund advisor rules. These rules impact funds, which is limited partnerships, the advisors, which is the general partner company, the advisor to the fund. It impacts many or a range of investment funds, private equity companies, all different types of funds that are being advised by fund managers, fund advisors. It impacts them. And these rules basically, in principle, do two things. They give a lot of new, or they enforce, or really provide in some detail, new investor protections are laid out in much more detail, especially for things like fiduciary obligations and other obligations that fund managers, fund advisors will have. Then you have the reporting requirements, the compliance and reporting requirements, more reporting and compliance requirements, and essentially other regulations that will definitely increase the costs of raising money from and dealing with U.S. investors over a long period of time. So let's deal with the first one. So this is going to become the norm. So the bar has raised. And so let's talk about this in the macro. This is 185 plus pages of code of rules and regulations that have been passed for private fund advisors. This is in particular going to target the sector involving LPs, GPs, small private equity companies, small and large alike. Certainly all less than less than 1.5 billion. So if you're a fund that has, say, 30, 40, 50 million, you're still caught in this. And the investor protections are basically things that U.S. investors and their lawyers are going to become used to, they'll want to have these things. And if you want access to U.S. advisors, you're going to have to take these rules into account, these new rules into account. Now, a lot of people are analyzing these rules, and obviously will do in the months and years to come. But for sure, I think on reading them first pass, I think that you don't really see the focus on the international. It's not, it's all over the international implications of these new rules are all over the place. But certainly what they call foreign private advisors, which is basically going to impact non-U.S. Advisors, non-U.S. fund managers, are definitely going to be impacted. And so U.S. investors are going to become more accustomed, and their advisors will become more accustomed and expecting of this standard of investment protection. And if they require this level of investor protection, then that means that the foreign advisor, the foreign private advisor, the foreign fund manager is also going to have to provide these protections. And as we already know, U.S. investors are already more conservative, see more compliance risk, see more potential for fraud in small international private equity, family-owned businesses that are alternative investment funds. So these are big implications for U.S. investors, and hence anyone seeking to raise money from U.S. investors. The expectations have just gone up. This is going to impact the way that you do your structuring. It's going to impact the way how much of your your investment structure is based in the U.S. And the more you place in the U.S., the more you're subject to private fund advisor rules and these rules and regulations that have come out. So it is going to be significant implications. The second thing is there's more regulatory reporting and compliance, which will drive cost. And if you are issuing securities and you register them in the U.S., it's going to drive costs. It's going to cost more money to have the reporting done and the compliance done. This is something I've commented about in other videos, is that the financial system all around is becoming more and more transparent, because there's more and more compliance requirements being passed and put into law, put into rules and regulations. And this is a prime example. So it doesn't matter that the U.S. doesn't really do information exchange. The U.S. does have lots of anti-money laundering and anti-corruption and other laws. And so their system is becoming more and more compliant. These are new rules and regulations which are going to drive transparency. And so you need to have your ducks in a row. You need to be organized when you're tapping U.S. investors. So we'll get into that more in the next video. Cheers.